Hey guys, welcome back to Be Rich. Today we're going to be talking about bonds, how they're a macroeconomic indicator about what's going to happen in the economy. And we're also going to be talking about the US economy, the recession, interest rates. So this is going to be a nice mix and match of macroeconomics with investing, and let's see what we have in store for us. So today I wanted to talk about how there's an inverted yield curve. So for those of you at home who don't know what an inverted yield curve, it's basically this. The idea is with bonds, in the shorter term, the interest rates paid on these bonds are lower per annum. And the longer term you get, so your 2-year bond is going to pay you less interest than a 10-year bond because there's a lot of risk in terms of how the macroeconomic factors will change. You don't know how the inflation rate will change. So to account for all these risk factors and the longevity of these bonds, you'll see that 10-year yields are much higher usually than short-term yields. But this fundamental principle gets violated when there is a recession inbound. Because when there's a recession inbound, what ends up happening is the central bank starts to raise rates in the short term, and that pushes up your short-term overnight lending rate. So your 2-year treasury bonds are going to be yielding much more than your 10-year bonds because people expect that in the long run, there'll be a recession and the Fed will come in and have to reduce rates. So your 10-year yield will be giving you a lesser yield than your 2-year yields. So that's exactly what's happening today in the US, and it's been happening since April of last year. So what's happened is the 2-year bond, which is the treasury yield in the US, has stood higher than the 10-year treasury yield. And this has gone on persistently for over a year. And interestingly enough, over the past 5 recessions, without fail, there's always been an inversion in the yield curve. But again, there's always the principle of correlation is not causation. So I wanted to first figure out what you thought about this indicator.
Correct. So first of all, let me explain this in layman's terms for someone like me in case of, and Karthik, who's behind the camera. So let's say when you buy a bond, what it's basically doing is you're lending the government money. Government is borrowing money from you. That's what you're doing. You're giving your money to the government, and government pays you interest like an FD, correct? So what Sashwath is saying is, there are different types. They can borrow for 2 years from you, they can borrow from 5 years from you, they can borrow 10 years from you. And when you put it in a graph, what happens is, for short term, the interest which they are willing to pay you, because you're only lending for a little time, they give you less money. But if you trust the government, and you say, I trust you, and you say, keep my money for 10 years, they give you, because of the trust you're placing in them, they give you more money, more interest they give you. So if you plot it and see, the graph will go like this, where as the years increase, you're getting more and more money. When we invert it, there's nothing but flipping it. That's what inversion means. So when we say that it is inverted, the yield is inverted, it's nothing but taking the graph, which usually looks like this, and doing this. What happens is, that means in the short term, government is desperate for money. So it's paying you more in the short term. But in the long term, they think things will go back to normal. So there will be no necessity to pay you so much. So it goes back down. So this is what he's basically talking about. When he talks about what's happening with this bond, what is an inverted yield. I hope Karthik has understood what we're talking about in the moments he's been paying attention to me. Maybe I should make Karthik come and do the explainer video. So this is what we're talking about. So why is this important? What happens in a recession? Recession is what?
Recession is when your economic output goes down and your GDP goes down.
Correct. That means the economy is slowing down. When the economy is slowing down, why do the interest rates go up?
Your interest rates go up because of a plethora of reasons. One, people are scared to lend. So people aren't going to be giving you money. There's a lack of capital, and what ends up happening is that the demand for capital stays, but your lack of capital means that your interest rates go up. That is, there's a lot of risk which people perceive, and they want higher returns for their money.
Correct. That means people don't think business is going to do so well. That means there's no guarantee that you claiming when you're doing business that you'll be able to sell their products and repay me. Basically, in essence, is that. There's another factor in this also, which is there, why the interest rate is going. The Fed is trying to soak up the money, free money which is there in the market. Let Shashwath explain what this free money soaking up is.
So free money, we've talked about in this channel multiple times, but over the past 10 or 15 years, since the 2008 subprime loan crisis which happened, the Fed had kept interest rates at relatively very, very low amounts, negligible even. It's been wavering between 0 to 2% at most. And what that's meant is that a lot of money has been pumped. So money has a value, it has a cost. That cost is your interest rate on the money. But if there's no interest rate, that becomes free money, because this money is now just being passed from hand to hand with no expectation of you paying anything more than the principal. So this money is being handed to you for free. They're saying, take it, do whatever you want with, just give it back to me.
Correct. So what's happened is there's lots of free liquid which is being flowing around from the US. US being the main economy of the world, the American dollar has been given there freely, and that is creeped all over the world. Like Uncle Warren investing in Japan, lots of small investors, big investors have been taking their dollars and putting it all over the world. That's been like permeating through the world economy, pushing the world economy up. Even the Nifty index, Sensex index are being held up and pushed up by all this free capital. Now the Fed is saying, hey, there's too much money now. Let's pull all this back, vacuum it back to this process of raising the interest rate, where money is becoming more expensive. Loans are becoming expensive. So people who borrowed at a low interest cost, now they want to pay off these loans. Why unnecessarily hedge? So all this money is going back to the US, strengthening the dollar, and all this money is going back. So this is how the money is removed from the economy, because they're fearing recession. So they want to somehow tame this inflation which is happening. That means cost per unit, they want to bring it down. So they want to put inflation, not only the inflationary expectations down, they want to physically, in reality, push these numbers down.
Yeah.
Now, there is slowly feeling in the American market. And the Fed is also saying in the news, we are going to pause for a little while and see how all this effort we have done. How is the patient doing? Like doctors say, they've given lots of treatment.
Observation.
They want to observe in the ICU for a few hours and see, is the patient responding to all this treatment we are giving? Because of this, lots of people are very positive. Instead of using terminologies like bullish, hawkish and all that, and dovetail, I want to say, people are feeling positive, are saying Fed now will hold it, and very soon will start dropping it. These are guys who are very positive. And there are people who are very negative, saying, no, they're going to wait for some time and realize the patient is even more critical and jack up the rates even further. So there is a bet going on. There are some people who are sitting on the theatre gallery, operation theatre gallery, saying, no, the patient is dead. The others who are saying, no, he's going to do very well.
Yeah.
So this imbalance you will see, this leads to people gambling on the bond market.
Yes.
Selling and buying bonds. So this is what we are seeing. This is what the article is saying.
And with an inverted yield curve, what ends up happening is lending goes down and credit creation goes down, because this is how banks operate. This is theoretical. This is how banks operate. Banks take money in the short term. That is, they borrow in the short term and for a lower yield, and then they lend out in the long term for a higher yield. So they make an arbitrage in this. And you might wonder how this is happening. If I'm going to give the bank a loan of only 2 years, how is the bank lending for 10 years? It's because over the period of 10 years, there'll be multiple suckers who come and give them a loan for 2 years. So they'll make up the gap. There are 5 of us going one after another will end up making the gap of 10 years, and they're more than happy to lend for 10 years. So they just rotate the money. And the profit they make out of it is the interest rate margin, which they get out of it. That's how banks work. But now the curve is inverted. So you don't have a positive gap anymore. So how are banks going to lend anymore? And if banks aren't lending, people aren't spending. And if people aren't spending, your corporates are screwed, because their profits are going to go down. One, and also number two, banks aren't lending, corporates can't borrow either. So it's a double whammy for corporates who are hit. So that's why inverted yield curves are reasoned to be a harbinger of recessions. But the article also goes on to say that something's different this time. The article says that yes, you're absolutely correct. The Fed has increased rates and your inflation expectations are high. The Fed is going to do something, and the bearish case or the negative case might be very strong. But the reason why the recession hasn't come about as of yet, that is, the job numbers are still increasing. Unemployment rate is still low in the US, because during a recession, unemployment rate goes up. That hasn't happened so far. So what the article is saying is this is because we as depositors are still giving money for dirt cheap to these US banks. The US banks haven't come out and said, I'm going to pay you more for your deposit. And we as consumers haven't demanded for that either. So banks are staying silent about this. They're saying, let the Fed do what they're doing. We'll keep doing what we're doing. And what that means is that the interest rate margin, which I've talked about before, has remained steady, which means that banks are still able to create loans and still able to pass off loans. And another factor being that if we are mortgage owners over there, last time the problem with the previous recessions were mortgage owners had floating rates, and also they borrowed at real interest rates. But this time, over the past 15 years, because of the free money which he's talking about, mortgage owners at a fixed rate or a fixed this thing, that is, as soon as you borrow it, that rate is fixed for you. At a fixed rate, they borrowed at about 0 to some 2%. And what that's meant is that even though interest rates are rising, it doesn't affect them much. So yes, if they lose their jobs, it matters. But as long as they're getting paid, they're able to still meet their EMI which they have on their mortgage property. So these are some of the reasons why the positive case people are saying that, you know, these are some of the factors which is why there won't be a recession. But that being said, I want to hear your opinion and you weigh in on this.
Correct. So now we have laid out what is all happening. As an investor, you're watching this channel and you're wondering, so what are you trying to tell me? What does all this mean to me? What this means is, if you're a trader, be careful. There's still a lot of uncertainty in the market. We do not know where these trades are going. So if you're betting, be very clear on if you're wearing your swimming trunks or not. 2, if you're a value investor, you're investing for a long term, 10 years, don't worry about it. All this news in a 10-year frame of mind won't make a difference. If I ask you 10 years ago what was the headlines, you won't even know what the headlines was. So it doesn't matter if you're a value investor. 3, if you're a person who's sitting,
doesn't matter.
This is like watching soap opera. It's like watching one of your channels like Sony or your Z channel. Something interesting is happening, or one of your son soap operas you're watching. It's like that. A lot of people talking heads getting really excited about nothing. So this is where it lies. So the main thing is, if you're a guy who's playing in the market on a daily basis, weekly basis, and you're positioning yourself, expecting things to go one way, things to go another way, all we're saying is there's too much uncertainty. Be very careful. Don't borrow. If you have borrowings, remove them from your table. These are the reasons why we talk about this. Why we're talking about all American economy, global economy, it's that reason. How does it affect you? Your borrowing cost is going to go up. So please don't borrow. And if you're a betting guy and you like gambling, this is not a market to be betting in, gambling in.
You could lose your shirt tomorrow.
Correct. Yes, you will read all these fancy headlines because they're all promoted and pushed, saying how one guy made 400 crores, one guy made 200 crores. Yes. But realize, for one guy to make those 400 crores,
some 1,000 guys had to lose 400 crores.
Yes. So be very careful. This is the reason why we do these videos, is to alert you. We're not advisors. We're not encouraging you to do one thing or another thing. All we're saying is, hey, be careful.
Yeah.
There's shark in the water. Be careful. Don't get eaten.
Yeah. And that's the thing, right? With investing, you'll have a lot of people telling you that you're going to miss your chance. You're going to have to jump in right now. There are so many opportunities. You'll miss Bitcoin. You'll miss NFTs. You'll miss this wonderful new stock which is climbing 10%, 20%. All that is bogus. You aren't missing anything. And better yet, you do what we talked about in the other video, where SIPing, where you just blindly close your eyes, ensure that you have it set up, and you don't have to worry about a thing about your retirement. That's how it is, and that's how the game should be played. Investing is about the long run. It's not about the short run. All this is noise. In a matter of another year or two, all this would have been under the water, blown over, and we'll have new concerns about whichever new president is there or what new prime minister. So much is there to talk about. But the idea here, as he said, is that all of it is noise. As a value investor, you have no reason to care about these things. So it's good to keep a hand on the pulse of the economy to see how things are. But that being said, don't get too carried away. Things will be fine. Things have always been fine.
Without furthermore, I think we can sign off and say thanks for watching Be Rich today. I hope you enjoyed today's video. If you did, please subscribe and turn on the bell notification to our channel so you're notified every time we come out with a new video. If this is something you think your friends or your family would like and enjoy, please do share this video with them. Once again, thank you for joining us on Be Rich.
Thank you.
I am in Tokyo on work on the 5th of August 2023. I have a lot of following in Japan, Tokyo. Those who want to meet me in Tokyo on 5th August, kindly drop me an email on the address given below or contact us on WhatsApp there. My team would get in touch with you and facilitate the meeting. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.